TSX investors holding positions saw modest relief as the composite closed higher despite persistent trade tensions. This is Modern Investing Techniques, episode 152. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. The S&P 500 rose 0.7% to 7,731. The Nasdaq Composite gained 1.6% to 26,541. The TSX Composite edged up 0.1% to 36,834. Financials led sector performance while technology lagged. The Fed remains divided on whether policy is tight enough, with incoming Treasury actions on bond yields adding uncertainty ahead of Jackson Hole. Remember, we covered X.to about 16 days ago. Today's TSX strength moves that forward because financials led the session. Earnings season continues with attention on revenue guidance from major tech names. The portfolio stands at a cumulative $250.04 across 57 simulated trades. Matched window alpha versus the Nasdaq sits at negative 5.44% across the 6 rules-based trades that began on August 18, 2026. Valuation discipline pairs depressed multiples with same-day volume confirmation to buffer against momentum rotations. Today's session showed financials outperforming while tech lagged, creating setups where lower multiples can cushion downside if volume supports the move. Investors can implement this by screening TSX financial names trading below sector average PE, then checking the 20-day volume average on the same day before entry. This approach has historically provided stability during growth index drawdowns when momentum names rotate out. Risks include false rebounds if volume fails to confirm, turning a buffer into a trap. Cross-reference with sector rotation signals to avoid isolated names. The sector table ranked financial services 6 points ahead of the S&P 500 and technology 7 points behind, with the tech shortfall concentrated in semis and software. Applying the screen requires pulling the latest PE ratios from a brokerage platform and comparing them directly to the sector median before checking volume bars. That same discipline applies directly to how U.S. dividends behave inside Canadian registered accounts. Imagine you added a U.S. dividend ETF to your Tfsa last quarter, expecting full compounding. Your brokerage credited the dividend at the announced amount, but the actual deposit was 15% lower because the IRS withheld tax at source before the shares reached your account. The mechanism works through the qualified intermediary system. U.S. payers route dividends through Canadian custodians who apply the treaty rate automatically for registered accounts. Yet the 15% still reduces the reinvestable sum each quarter. Most retail investors miss that growth-oriented U.S. names with low or zero dividends minimize this drag compared with high-yield payers. The pro tip is to run a quick screen for dividend yield below 1.5% before adding any U.S. equity to a TFSA. Then compare the after-withholding yield against an equivalent Canadian-listed ETF. The concrete misconception to avoid is treating the headline dividend as the net amount you will actually compound. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Today's practice investment update shows no new position. We are monitoring NVDA for volume confirmation above the 20-day average on the record sales catalyst. NVIDIA reported $96.2 billion in sales, with a 70% revenue growth forecast for 2028. The technical setup requires a volume spike relative to the 20-day average and position versus the 50-day moving average. Risk assessment remains low because the setup lacks volume confirmation after the recent drawdown, so position size stays at 0. The invalidation line is daily volume failing to exceed the 20-day average within 2 sessions of the sales announcement. This exercise demonstrates how to stay disciplined when a headline catalyst appears, but supporting data lags, preserving capital while keeping the name on a short watch list. Listeners learn to name the exact missing condition rather than forcing a trade. Yesterday's weekly hold was EQB.TO on a valuation screen for a Canadian bank trading at a discount to sector peers. The position entered at $133.19 on the Friday open and exited at $125.50 on the Thursday close. The result was a loss of 5.77% or $57.74 on a $1,000 position. The valuation entry lacked volume support and was caught in broader financial sector rotation. What this teaches us is that pairing valuation screens with a same-day volume check is required before treating any rebound as confirmed. The Unusual Whales GEX Heatmap now refreshes gamma exposure data near second to second. This allows traders to spot dealer hedging flows in real time rather than waiting for end-of-day snapshots. Active options traders on U.S. equities should use the free tier at unusualwhales.com to test the updated heat map before considering paid features. The Rallies AI Arena ChatGPT portfolio tracker shows the ChatGPT-driven portfolio more than doubling since April. Canadian investors can replicate the approach by feeding earnings transcripts and sector data into a local model, then comparing results against their own Tfsa holdings. The free X account at Stock MKT News publishes weekly updates that serve as a starting benchmark. Venezuela is evaluating departure from OPEC, which could alter global supply dynamics and affect energy price volatility for Canadian producers. The action here is to hold existing energy exposure, but add no new positions until supply impact clarity emerges. OnlyFans has distributed over $30 billion to creators, highlighting sustained consumer spending in digital platforms that may support related advertising and payment stocks. Watch consumer discretionary names with digital ad exposure for volume confirmation before adding. 72% of Gen Z remains financially dependent on parents, pointing to longer-term shifts in household savings rates and potential demand for education-focused fintech products. Avoid adding consumer lending exposure until clearer data on repayment trends appears. The portfolio now sits at a cumulative $250.04 across 57 simulated trades at a 53% win rate. Average return per trade is positive 0.44%, with the best at positive 20.11% and the worst at negative 11.80%. The 6 rules-based entries under the publish, stop, and holding rules give the negative 5.44% matched window alpha a concrete sample size. The current streak is 1 loss. Before we wrap, pull up NVDA's daily chart and check whether today's volume exceeds the 20-day average. If not, set an alert for the next spike. That's it for today's modern investing techniques. The resources page has links to everything we discussed. Subscribe and share with someone who wants to go beyond index funds. See you tomorrow. And if you'd rather watch than listen, find us on YouTube at Nera Network. Links in the show notes. This show comes to you from the Nera Network. If you want another sharp daily briefing, Planetarian Daily has you covered. Daily breakthroughs in science, health, and longevity. All our shows are free at neranetwork.com. New to the network? neranetwork.com, start here, picks the right daily briefing for you in about 2 minutes. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking